Hey there. Ever looked at your investment earnings for the year and just felt a little lost when it comes to taxes? If so, you're in exactly the right place. Today, we're going to demystify the rules using the official IRS guide as our treasure map. Okay, so let's dive right in. This is our guide for the journey, IRS Publication 550, which is officially called Investment Income and Expenses. This is the real deal, the definitive source from the IRS, and we're going to break it down together. So, if you've sold some stock, earned dividends, or maybe collected interest from a savings fund, yeah, this explainer is for you. We're going to walk through exactly how the IRS looks at that income and what you need to do about it. All right, first up, let's get our bearings. We're going to start by understanding what this publication actually covers and why it's pretty much the essential map for your financial quest every single tax season. I know. An IRS document can look pretty intimidating, right? But honestly, instead of seeing it as a complex legal document, try to think of Publication 550 as a tool. It's literally designed to guide you step by step through reporting everything correctly. So what's actually in this guide? Well, it covers the whole shebang. What income you have to pay tax on, what expenses you can deduct, what happens when you sell something, and, most importantly, how and when you're supposed to report it all. Now, let's tackle the first big piece of the puzzle. What does the IRS actually consider to be investment income in the first place? As you can see right from the source, the official definition is, well, it's pretty broad. It's not just the profit you make from selling stocks. It also includes the interest from your savings account, the dividends you get from companies, and even distributions from your mutual funds. And this is pure gold. This table, pulled straight from the guide, is basically your cheat sheet. It shows you the exact line on your tax form where you report some of the most common types of investment income. No more guessing games. Okay, every good journey has a few tricky sections. So now we're going to navigate some of the more specific rules about bonds, and we'll touch on a concept called original issue discount, or OID. Let's begin with something a lot of people have: U.S. savings bonds. Now, these are a little different from, say, a regular savings account because you actually get a choice about when and how you report the interest you earn on them. And this really lays out your two options. Method one is the simple route. You just wait and report all the interest that's built up in the year you finally cash the bond. Method two is where you report the interest as it grows each year, which kind of spreads out the tax hit. Now, a key tip here. If you're thinking about using these bonds for education, method one might be the better way to. But what if you own a bond with someone else, like your child or your spouse? Well, this table clears it up perfectly. The tax responsibility follows the money. So if you paid for the bond with your money, you're the one who reports the interest, even if someone else's name is on it too. Now for a really powerful tip that's kind of hidden inside Publication 550. Under the right set of circumstances, the interest you earn on certain savings bonds can be completely tax-free if you use it for higher education expenses. But, and this is a big but, there are strict rules. It has to be a specific type of bond, one issued after 1989, you had to be at least 24 years old when you got it, it's got to be in your name, and the money has to be used for qualified expenses. And definitely keep in mind, there are income limits to qualify for this tax break. All right, ready to level up a bit? Let's tackle a concept that sounds super technical, but I promise it's not as scary as it seems. We're talking about original issue discount, or just OID for short. It's basically a form of interest on bonds that you buy for less than their face value. So here's the official definition, but let's just break it down. Imagine a zero-coupon bond. You buy it for, say, $800, and you know it'll be worth $1,000 when it matures. That $200 difference? That's the OID. And it's treated as interest that you have to report over the life of the bond, even though you won't see that cash for years. The good news is, the IRS has a rule for tiny amounts of OID. It's called the de minimis rule. If the discount is really small, less than 0.25% of the face value per year, you can basically just treat it as zero and not worry about reporting it as it accrues. Pretty handy, right? Next up, let's look at what happens at the end of an investment's life cycle, the sale. This is often where the biggest tax events happen. Chapter 4 of the guide is dedicated entirely to this topic. And the main takeaway is this. Anytime you sell or trade an investment property, whether it's a stock, a bond, or a mutual fund, you've just created what the IRS considers a taxable event. And the core concept you've got to understand here is the capital gain or loss. It's really simple. It's just the difference between what you get from the sale and your basis, which is usually just what you paid for the asset. If you sold it for more than you paid, that's a capital gain, and you'll probably owe some tax on that profit. Finally, to make sure you navigate your taxes successfully every single year, let's go over a few essential rules from the guide that you absolutely cannot forget. Think of this as your hero's toolkit. Rule number 1, keep good records of everything: what you bought, when you bought it, how much you paid. Rule number 2, always provide your taxpayer ID number to banks or brokers. And rule number 3, understand backup withholding because you really want to avoid it. And this number is why it's so critical. If you don't give your bank or broker the correct taxpayer ID, they are required by law to withhold a flat 24% of your earnings and send it directly to the IRS. It's not optional, so you've got to make sure your info is correct. So, with the map of publication 550 in hand, you are now much better equipped to handle your investment taxes. The whole journey starts with good preparation. So the final question I'll leave you with is this: are your records organized and ready for your tax quest?